4%. That's how far the Nasdaq crashed on Friday. The worst single-day drop since April 2025 and the worst week this index has had in over a year. This just happened, and most investors have no idea what it actually means for their portfolios yet. Here's what's really going on, and what you need to be thinking about right now. Because this isn't just a bad day, there's a specific trigger behind this sell-off that could change everything you thought you knew about this market. Friday's jobs report came in hotter than expected. Way hotter. That single data point sent shockwaves through prediction markets. Fed rate hike odds surged. Not cut odds. Hike odds. 2 Federal Reserve officials came out publicly and said a rate hike is still on the table for 2025. Not a pause. A hike. The market heard that and panicked. Growth stocks got obliterated. Nvidia, AMD, the entire chip sector, hammered across the board. The QQQ, the ETF that millions of retail investors hold, dropped in lockstep. If it's in your portfolio right now, you felt this personally. AI sentiment, which has been carrying this market on its back for 18 months, cracked simultaneously. 2 threats hitting at the exact same moment. Rising rate expectations and cooling AI conviction. That's not noise. That's a structural warning signal. But here's what nobody is saying about this yet. The real danger isn't Friday's drop. It's what a rate hike does to valuations on a forward basis. High multiple tech stocks, companies priced for perfection, get mathematically destroyed when the discount rate rises. We're talking about price-to-earnings multiples that were already stretched at 35, 40, 45 times earnings. A single rate hike compresses those multiples fast historically. That compression doesn't stop at 10%. It doesn't stop at 15%. It runs until the math works again. While retail investors were buying the dip all week, institutional money was quietly rotating. Defensives, energy, financials, sectors that actually benefit from higher rates, saw inflows. The smart money already moved. The question is whether you did. 3 things to consider right now. Educational perspective only. 1. Audit your tech exposure immediately. If Nvidia, AMD, or QQQ represent more than 20% of your portfolio, rising rate odds just changed your risk profile whether you wanted that or not. 2. Watch the next Fed communications like a hawk. Any language that shifts from patient to data-dependent tightening is your signal that this sell-off has more room to run. 3. Don't confuse a dip with a bottom. Before buying this drop, ask yourself, are you buying a discount? Or are you catching a falling knife in a rate regime reversal? Is this the start of a deeper correction? Or is the Nasdaq about to rip back and make Friday look like an overreaction? One of those outcomes is going to make investors serious money. The other is going to destroy portfolios that didn't reposition in time. Drop your call below. Correction or comeback? This video is for educational purposes only, not financial advice. Always consult a qualified advisor before making any investment decisions.